Welcome back to Investing Talk Podcast. Today, we're taking a close look at Snap. A company that's really captured the imagination with its platform, but, well, it's consistently kept investors guessing. The big question on everyone's mind, probably yours too, is Snap a good time to buy now? We're going to try and unravel that enigma today, cut through the noise, and give you what you need based on, the latest developments and numbers. And hey, before we jump in, if you find this kind of analysis helpful, please do take a second to subscribe, maybe like this episode, and definitely leave a comment below. Your engagement really helps us keep doing this. Oh, and maybe consider buying us a coffee to support the work. Also, if there's a specific company you'd like us to tackle in the future, just pop its name in the comments and we'll add it to our list. Okay, so today we're diving into Snap's recent bumps in the road, its fundamental financial health, how the market's valuing it, what's coming up, and of course the risks involved, all to help you make a more informed decision. Our expert here is going to help us connect those dots. All right, let's get started. Snap has really been through it lately, hasn't it? From your perspective, what's been the most critical thing shaking things up for them over the last, say, 3 months?
Yeah, it's really been a convergence of factors, almost like a perfect storm hitting them. Multiple significant events have just piled up, creating a really challenging environment, both operationally and in the market's eyes.
Okay, let's break that down. Starting with August, Snap raised $550 million with those senior notes. Now, is this just smart financial management bolstering liquidity, or does it hint at maybe a more pressing need for cash?
Well, it's primarily about strengthening their balance sheet and dealing with existing debt, so, refinancing. But while that helps on paper, it definitely raises some eyebrows in the market.
Eyebrows about specifically dilution, costs.
Exactly. Concerns about potential near-term dilution for shareholders or maybe higher interest costs down the line. The market watches these moves closely, wondering if it's just, kicking the can down the road financially.
And then there's the legal stuff. That class action lawsuit alleging securities fraud. How serious is that? Just noise or a real potential headache for management?
It absolutely adds another layer of pressure. I mean, it's legal and regulatory scrutiny on top of everything else. It can definitely impact investor sentiment and, frankly, distract management when they need to be focused on turning the business around.
Right, especially when they were already dealing with the fallout from that Q2 earnings miss. We saw analysts downgrading, calls for accountability.
Precisely. That Q2 miss really lingered, keeping the share price under pressure and fueling those concerns.
Okay, let's rewind a bit to July then. That Q2 release itself, huge user growth, right? 932 million users is massive.
It is, yeah. The community growth is definitely a bright spot. It shows the platform is sticky, especially with younger demographics.
The ad business struggled. How does that work? All those users, but the money isn't following as strongly.
That's the core paradox for Snap, isn't it? Great engagement, but the ad business challenges, and particularly the weak guidance they gave for Q3, well, that led to a really sharp drop in the share price.
Ah, the guidance. So management basically said Q3 would be tough too?
Yeah, they pointed to ongoing ad pricing challenges and slower monetization. It basically signaled that the problems weren't a quick fix. And analysts, well, they reacted predictably.
Downgrades and price target cuts.
Yep. Multiple analysts revised their targets downwards, reiterated hold ratings. It showed this sort of cautious wait-and-see approach, clearly emphasizing that, significant operational improvements are needed before they get more bullish.
Now, back in June, they were talking up investments in AI and machine learning for ads. Is that the potential fix? How game-changing could that be, realistically?
It's definitely a strategic move, trying to use tech to improve ad personalization and measurement, which could reignite growth. But these things often take time.
Right. It's not an overnight solution.
Not at all. And the market, it wants results now. It's a long-term play in a short-term focused world. Plus, they were also continuing with cost management.
More job cuts.
Yeah, additional headcount reductions. They'd already cut over 7% in the previous year. It shows they're serious about efficiency, which is frankly crucial when you're still losing money.
And all this while juggling, what is it, $3.5 billion in long-term debt?
Exactly. Managing that debt load while trying to navigate ongoing losses. It's a really tough balancing act. It adds another layer of risk and scrutiny from investors.
Okay, so that's the recent turbulence. Let's shift gears now and look under the hood. What's the fundamental health of Snap, and how are they actually stacking up against the competition?
Right. This gets to the core question. Can they actually turn all that user engagement, which is impressive, into sustainable profits? That's the billion-dollar question for Snap.
Looking at the full year 2024, revenue was around $5.5 billion, up about 7% year over year. Some recovery there.
Some recovery, yes, but 7% growth isn't exactly setting the world on fire, especially after some really sluggish prior quarters.
Oh, yeah.
And the key thing is they still posted a net loss of, what, $1.25 billion?
Ouch. Yeah, $1.25 billion loss.
That's the fundamental challenge right there. The gross margin, around 47%, is okay. Not amazing, but okay. But the negative operating margin tells you they just aren't generating profit from their core operations. They're spending more than they make just running the business.
And that Q2 2025 continued the trend. Revenue was $1.34 billion, a little better than expected, but still an adjusted EBITDA loss of $150 million.
Exactly. And that adjusted loss is key. Even when you strip out things like interest, taxes, depreciation, they're still losing money on an operational basis. Revenue is coming in, but profitability just seems elusive.
What are the projections looking like for the rest of this year, 2025?
Well, consensus estimates put full-year revenue somewhere between $5.7 and $5.8 billion, so continued modest growth. But persistent net losses are still expected.
Yeah.
And management's own forward statements haven't really painted a clear picture of how they get to profitability. That lack of a clear path is a worry.
Let's talk balance sheet. As of June 30th, they had $3.1 billion in cash, $2.3 billion in debt. That sounds reasonably healthy, net cash positive.
It is a strength, yeah. Having more cash than debt reduces that immediate liquidity risk, which is good. But we need to look at cash flow.
Okay.
Operating cash flow over the last 12 months was actually positive, about $197 million. But free cash flow was negative $53 million.
Why the difference?
Because free cash flow accounts for capital expenditures, the money they spend on things like servers, buildings, equipment, and also things like share-based compensation. So you factor in all their investments and costs, they were actually burning cash overall, not generating enough to cover everything.
And that feeds into the accumulated deficit, which is now over $10.5 billion.
That's right. That massive number represents all the losses piled up over the years.
Yeah.
It's a huge hole they've dug, eroding shareholder equity. For long-term investors, that's a critical point. It means they constantly need to prove they can overcome that history.
Okay, let's talk competition. It's a brutal space. TikTok, Meta with Instagram. How does Snap really stand out besides the Gen Z appeal?
Their strength is definitely that strong engagement with Gen Z and their continuous innovation, especially with AR lenses and Bitmoji. They're creative, but, as we've said, the monetization just lags behind the big rivals.
So no real durable moat, as they say. Nothing truly defensible.
Not really, no.
No.
Their heavy reliance on mobile ad revenue makes them very vulnerable to shifts in ad budgets, platform policy changes like we discussed. There isn't a strong, unique advantage that consistently protects their profits or market share.
All right, let's move on to valuation and what the charts are saying. This is where the rubber meets the road for many investors.
Absolutely. These metrics help us gauge how the market is currently pricing Snap, factoring in everything we just discussed, the potential versus the persistent problems.
Okay, PE ratio is obviously not applicable given the losses. What about price to sales, the PS ratio?
As of early September 2025, their PS ratio was about 1.35x. That's based on their trailing 12-month sales. It tells you the market is paying about 1.35 for every dollar of Snap's annual revenue.
How does that compare?
It's lower than some giants like Meta, which might trade around 3.5x PS, but maybe higher than some other unprofitable peers. So kind of in the middle.
And price to book, PB. You mentioned that was high at 8.1x, way above the peer average of 4.5x.
Yeah, that 8.1x is quite high. Now, sometimes a high PB suggests the market sees huge intangible value brand growth potential. But with Snap, because those accumulated losses have eaten away at their book value, the B part of the PB ratio is quite low.
Ah, so the ratio looks high partly because the denominator, the book value, is small.
Exactly. It reflects the erosion of equity as much as it reflects perceived potential. It's trading at a premium on this metric, but maybe for less than ideal reasons. Compared to its own history, it's below average on PS, but at a premium on PB.
Yeah.
It's complicated.
What about discounted cash flow, DCF models? Do they offer any clarity?
Most DCF models struggle to justify the current price unless you plug in some pretty optimistic assumptions about them reaching sustained profitability quite soon. The upside really hinges on execution. They have to prove they can make money consistently.
Okay, let's switch to the technicals. What have the charts been doing recently? Any key levels traders are watching?
Well, in August and early September, the stock was trading roughly between $6.80 and $7.90. Technical analysts would point to support around $6.70 a level where buyers might step in and resistance near $8.10 where sellers might take control.
And the moving averages, where's the price relative to those?
The 50-day moving average was around $7.12, and the longer-term 200-day was about $8.03. The price has been trading below both of those recently.
Which is generally seen as?
Generally seen as a bearish signal, yeah. It suggests the recent trend and the longer-term trend are both pointing downwards, or at least lacking strong upward momentum.
What about momentum indicators, RSI?
My CD.
The RSI Relative Strength Index was sitting around 45. That's pretty neutral, maybe leaning slightly towards oversold, but not strongly indicating a bounce is imminent. And the MAN-CD moving average divergence was negative, also signaling weak upward momentum.
So technicals look kind of weak overall. Yeah, combined with high volatility option prices suggest big swings are expected. The technical picture points towards continued choppiness and risk, rather than a clear upward path right now.
Okay, looking forward then. What are the potential catalysts, any rumors floating around, and the key risks investors need to keep front and center? The next few months sound pretty crucial.
They really are pivotal. There are several specific dates and potential events that could significantly swing sentiment and the stock price. These are the things to watch.
Like what? It's September 16th and 27th mentioned for index rebalancing?
Right. Institutional rebalancing, and then the big S&P Dow Jones Index quarterly rebalances. These might not seem like company news, but they can cause significant buying or selling pressure just based on index rules, leading to unusual volume and potential price dislocations, especially if Snap's weighting changes.
And then the really big one, October 28th, Q3 earnings.
Absolutely critical. Everyone will be watching user growth again, of course, but more importantly, those ad revenue trends and any tangible progress on the AI and machine learning initiatives they talked about.
So a beat or improved guidance could spark a rally.
Potentially, yes. A positive surprise could trigger a re-rating. But conversely, if ad trends remain soft or guidance disappoints again, it could really exacerbate the bearish pressure. It's a make-or-break report, arguably.
After that, November 20th, the holiday ad season kicks off, and December 15th, those 13F filings.
Yeah, the holiday season start gives early reads on ad spend, crucial for Snap. And those December 13F filings will show us what major institutional investors, the big funds, did during Q3. Did they buy more Snap? Sell? Hold? That can definitely influence sentiment.
Okay, beyond the scheduled stuff, what about rumors? Any market chatter that could be significant?
Well, there's always the persistent speculation about Snap being an acquisition target. A larger tech or media company wanting their user base or tech. It bubbles up now and then, though it's purely speculative.
Anything else?
There are also whispers about potentially strong growth in their paid subscription service, Snapchat plus AV. If that's real and significant, it could help margins by diversifying revenue away from just ads.
And AR augmented reality.
Yeah, speculation continues that they might announce a major AR ad tech partnership or expansion before year-end. That's kind of their unique angle. And, there's also chatter about possible management changes, C-level succession, or bringing in outside help to speed up the turnaround. That often surfaces when a company struggles.
Any recent news pointing one way or the other? Insider buying? Analyst shifts?
Not much positive, frankly. There was a proposed insider sale in late August, but it looked like part of regular compensation, not a signal of lack of faith, necessarily. But importantly, no major insider purchases in the past year.
And analysts?
Wells Fargo downgraded them from buy to hold back in August, citing the ongoing losses and slow ad growth. Generally, the news flow and analyst commentary remain pretty skeptical, focused on the profitability hurdles and the competitive threats. Social media sentiment seems mixed to negative too, less retail buzz than maybe in the past.
Okay, let's crystallize the risks. What are the absolute key things an investor needs to be wary of here?
Well, stock-specific risks are huge. Number one, persistent net losses and the related risk of needing to raise more money, potentially diluting existing shareholders. That's straight from their own filings.
What else?
Platform dependence. Being so reliant on ad revenue makes them vulnerable to policy changes by Apple or Google, which could disrupt their whole model. And there's the risk that user growth could stagnate, especially in mature markets, if new features like AR don't really pull in significant new users.
And the broader market risks.
Digital advertising is cyclical. If the economy slows down, ad budgets get cut, and Snap feels that. Plus, the social media space is just hyper competitive. They constantly need to innovate just to keep up, let alone get ahead against giants with much deeper pockets.
So wrapping this all up, we've looked at the recent headwinds, the shaky fundamentals despite user growth, the mixed valuation signals, the weak technicals, upcoming catalysts, and significant risks. What's the bottom line? What's the overall investment thesis for Snap right now?
Look, in summary, Snap has undeniable strengths. Strong liquidity for now, and that really impressive user engagement, especially with younger demographics. That's valuable, but, and it's a big but, those strengths are significantly outweighed, in my view, by the persistent large net losses, the lack of a clear near-term path to profitability, and the absence of a really strong, durable competitive advantage or moat.
So for our listener asking, is Snap a good time to buy now? What's the verdict?
Based on all this, the overall rating we'd give it is probably a 3 out of 10. The technicals, as we discussed, point to volatility, which might appeal to some very active short-term traders playing the swings around earnings or news.
But for long-term investors?
For long-term investors, the fundamental picture remains weak. It looks better suited for tactical trading than as a core, stable, long-term investment right now.
So the long-term story just isn't compelling yet. Needs more proof points.
Exactly. You'd need to see a clear, sustained turnaround in margins, or some truly game-changing product innovation that clearly drives profitable growth before the long-term case becomes strong. Right now, it feels more speculative than foundational.
Okay, that was a really thorough breakdown of Snap, a company, as we said, with great user appeal, but facing some serious business challenges and intense competition, and some key moments coming up that could really push it one way or the other.
Absolutely. The next few months, especially that Q3 earnings report and how institutions position themselves, will be really telling. They could start to shift the narrative or confirm the existing concerns. It's definitely a critical period for Snap. So as you mull over everything we've discussed, here's a final thought for you. Given Snap's high volatility, all those near-term catalysts, the rumors swirling around, what single factor do you think has the most potential to either spark a significant short-term rally or trigger a further slide? Is it finally seeing results from those AI ad improvements? Could it be the outcome of that lawsuit? Or maybe, just maybe, one of those acquisition rumors actually pans out? Something to think about. We really hope this analysis helps you navigate the complexities around investing in Snap. If you found this discussion valuable, please do remember to subscribe, like this episode, and leave us a comment. Your feedback honestly does fuel our work. And you can always support us by buying us a coffee. The link is usually below. And please don't forget, if there's another company you want us to examine, just drop its name in the comments. We do look at those suggestions. Thanks so much for tuning in to Investing Talk Podcast. We'll be back soon with another analysis.